Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. Today on the show, we've got Michael McCloskey of GreensKeeper Asset Management, and he is an unabashed value investor. And today we do what I know you guys love, just pure stock picking. We talk about at least 10 that I counted stocks that are value stocks, and he tells us quite simply, would he buy them or would he dump them, including some harsh realities for yours truly. Some stocks that I'm sitting on, unfortunately, that he does not have a great outlook for. We had a lot of fun this episode. And of course, as always, he gave us his 3 high conviction ideas. And if you want those ideas right to your inbox, just a reminder, go to our website, inthemoneypod.com, smash that subscribe button, and you will never miss one of those pro picks. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO InvestorLine. All right, In the Money listeners, you're constantly analyzing charts, spotting trends, and making calculated moves. That's where BMO InvestorLine comes in. Take your trading strategy to the next level with their advanced platform packed with real-time data, options analysis tools, and commission-free ETF trading. Start investing today at bmo.com/investorline. Michael McCloskey, thank you so much for joining me on the podcast.
Thank you for having me, Amber.
You are a value investor, and you wear that as a badge of honor. And I say that because value investing is really tough sometimes.
Yeah, and we're going through one of those times this year where I think meme stocks are on fire. Yesterday it was Open Door. Today it might be Kohl's. I mean, Bitcoin, things that I don't put value in are just going to the moon, as they say. So I run towards trouble. When stocks are out of favor and nobody likes them, that's when they're cheap. And so, you know, like a firefighter, you got to be trained. It's against our nature to run towards danger. But as a value investor, I have the right temperament to know that it's not popular and that's okay. I don't want to go where everybody else is. That's when you find cheap stocks.
You are speaking my language because I feel like I am such a sucker for a stock at a 52-week low, and there are a lot of large caps that are at a 52-week low. How do you separate value from value traps?
Okay, so I think value investing is misconstrued by a lot of people. If you watch the evolution of the best who have done it, Buffett in particular and Charlie Munger, Buffett in his early days used to follow the Ben Graham style of value investing. We're going to look for asset-heavy businesses that are trading at a low price-to-book multiple and tangible assets. The world has changed. We're in the new generation of software, asset-light businesses. And so what Charlie, the best thing he did for Warren was say, stop buying these cigar butts is what they used to call them. And that can still work where you buy 20 stocks, but as you get bigger, it doesn't work and it doesn't scale. It's better to buy a great business at a fair price. Compounders. And that's really what I try and look for is not these mediocre businesses. I want to buy the best in the world. And if you buy the best in the world, let's take the Visas of the world. It's not going to be a value trap if it's disliked for a point in time and you get the business right. I know that it's going to continue to compound. Even if the market doesn't recognize that for a period of time, the value of the business keeps growing. And so time is your friend and not your enemy.
I think that's important. Like, I think about myself as like a long-term investor. I'm young, so I'm going to stay in for like 25, 30 years.
More
at least, right? So I try and think about that when I'm down so much. And I like to use these shows as a bit of therapy. So let's...
I'll send you a bill.
Some rehabilitation. So I always use Pfizer as like, I feel like such a sucker. I bought Pfizer. I bought Nike.
Oh, the drug company.
The drug company. I buy these companies. They're at 4-year lows, and I'm thinking like you, because I'm like, look at this business. This is a tried and true business. It's going to be around for like 50, 100 years,
right.
And the market is just not giving it a fair shake. And I get lured in like an idiot, and I'm down like 10, 15%. So do you find comfort in that, or because you're a long-term investor, or what was my mistake? What was my blind spot?
Well, I don't want to say it was a mistake. You got to get the business right long-term. Nike's a great example. I've owned Nike in the past. I saw what you did in terms of the price earnings multiple, the collapse of the stock. I didn't buy it this time, and I owned it, 10 years ago. So what I'm seeing over the last 3-5 years is they made a mistake strategically where they used to distribute a lot of their product with, I think it was Running Room. And they started to go direct to consumers and upset their business partners. And then some of their upstart competitors, Hoka, I'm seeing more and more of those shoes everywhere. And so if you're a retailer that used to be a big Nike partner and you treated me like that, I'm going to remember that. And more importantly, that opening allowed On and Hoka to have more mind share with the consumer and good reputation. So I think Nike's competitive position is deteriorated. And I think that's what you're seeing with the stock. So it might work out for you, Amber, and I hope it does.
Me too.
I think it's important not just to look at a multiple. You have to look long-term at what is the business going to do long-term? And you got to get that right. And if you get that right, it'll work out.
Your career in this industry, not as unconventional, but you started as a lawyer.
Yes.
Then you were an investment banker.
Yes.
And now you find value stocks for a living, and you try not to fall into these value traps. Can you talk to me? And as I understand, your math degree,
mathematics, my undergrad. Yeah.
So math, law, MBA. So really, my Indian parents would have loved you. You're hitting all the points. But I want to know, how did you come to value investing with that kind of career, with that kind of resume?
Yeah, so law, I fell into law. I partied a lot at university when I was studying mathematics. I was going to go and do my MBA at Ivy. I didn't get in. My daughter, who did, bugs me about it all the time. And so I pivoted to law. My first year roommate at undergrad, I said, Joe, what are you going to do? And he said, I'm going to go to law school. And I said, that sounds good. I jumped on a bus. I wrote the LSAT. I got into Osgood, decided to do the MBA, and then started in law, which taught me how to write, taught me about how the world works, critical thinking. But I always knew I was attracted to the market from the time I was a kid. And so there was an investment bank that was owned by Eric Sprott. The next generation was buying that business. I think you know somebody who used to work there. And so I joined them at a really good time. It was the early aughts. And I was there from 2002 to 2010, I believe.
Great time for commodities.
Markets were terrific. Yeah. Exactly. Our Calgary office, our Toronto office, metals and mining in particular, we did great. And that's where I learned about markets and how they really work.
So why aren't you a commodities? Usually people who come up during that era, that's all they're going to do. They're still doing it now.
I never covered that sector. I was I think I was investment banker number 3, and number 2 started right before me. We built the business, and I covered financial services, technology, and a few other sectors. I never covered metals and mining or oil and gas. So I don't know that space as well. But one of the fortuitous things when covering financial services is the analyst I was paired with in that sector was Jason Donville.
Oh, yeah.
So I walked into Jason's office one day in the early days, and he had Buffett's annual letters to shareholders on a shelf in a binder. And I said, what's that? And he told me, and I said, can I borrow it? I mean, I'd heard of Buffett, but I didn't really know what he was all about. And so I literally borrowed his printed out copies of the annual report. And for me, it just clicked. And that led me to the Intelligent Investor. And then I've never stopped. Innately, that's who I am. I'm a logical, conservative, anti-risk taker. And so that style just resonated with me, and it's gone from there. It's
so interesting because I think of Jason Donville and Canadians who know his style, growth. He would say, I think, at a reasonable price. I look at some of his holdings sometimes, and I question how he got to the reasonable price part of it. But that seems so are you owning a Constellation Software? What were some of his big names back in the day? That seems like not your style at all.
Well, I think GARP, or growth at a reasonable price, it's just the other side of value. A business that's going to grow really fast is worth more than a business that's growing slowly. And growth is actually a good thing because it saves you. The value of the business continues to increase. I don't want to speak for Jason, but I tend to be a little more conservative in terms of the multiple I'm prepared to pay. It kills me to pay 20 times earnings for any business, including a Visa, which I think is one of the best businesses in the world. It's worth more than that. And I did, and it's worked out great. Constellation, I think, is an amazing business. And what Mark Leonard has built in his culture, I have never been able to get there in terms of the valuation, ever.
So let's use that as an example. Constellation, this is a blanket statement, but Constellation never goes down. In its history as a publicly traded company,
Sure.
it is, on an annual basis, has only had one down year.
Okay.
It just always goes up.
Yes.
And so using valuation in hindsight was not the right metric to decide whether the stock was going to do well.
Yeah, so far. I anchor to what a stock is worth. I tend to not look at what it's done historically. I want to look at what's the free cash flow of the business over its reasonable lifetime. And that allows me, for certain businesses, I can't value certain businesses, but a Constellation, a really high quality business that's consistent, I can predict a reasonable multiple or estimate of that business. And so I just anchor to that. And if it's trading at a material discount to that, I buy it. And if it's not, and Constellation's never traded at where it is, it becomes a little bit of a cult stock. And Tesla is a different example, because I think Constellation's a great business. Tesla's not a stock, it's a cult. If you actually look at the fundamentals, you cannot get there unless you believe amazing, amazing things are going to come. And, there was an article this morning saying, well, they're reporting squirrel. As soon as there's something with the business that isn't going well, he will pivot to robots or something different. And that's fine. That's not the game I play. I want to stick to what is a business worth, identifying those great companies, putting it on my watch list, and then just waiting for an opportunity. And the hardest part for us isn't identifying those great businesses, because it's obvious. The numbers just sing to you. It's finding those opportunities to buy them at a great price. And so we just build our watch list all day. To be a value investor, you can't want a lot of activity. We don't trade very much. We spend all our time just reading, thinking, valuing businesses, and then waiting. And once you find a compounder and you buy it at the right price, you're kind of done. Like, you need to monitor it, but it should compound for a long period of time.
And I guess you also have to be, you don't have FOMO, like, as a clear way of saying it. You look at GoPro up 70% today, you don't think like, that could make a year.
Yeah, I don't really care. Like, Bitcoin is another example where it's hitting all-time highs. The president of the United States is, trying to back it. I don't get it. And some people do, and that's great. I can't value it. I don't think anyone can value it. Mm-hmm. So I'm not going to buy an asset because of what I think someone else is prepared to pay for it someday. If I know that a business is generating a lot of cash flow and I got a pretty good idea of what it's worth, value will come to that point at some point in the future. I don't know exactly when. And that's the game I play.
All right. Well, let's talk about it in terms of stocks and dip into the mailbag.
Sure.
Our first question is fittingly about Berkshire Hathaway.
Okay.
Is now a good time to get into Berkshire Hathaway? What do you think about Warren Buffett stepping down?
I'll start with the second question. Warren stepping down, it was obvious. It was telegraphed. It was leaked by Munger a few years ago who the successor would be. It's a Canadian, which is terrific. It doesn't surprise me that he's stepping down. I have gone to the meeting many times. I didn't go this year. Last year, after Charlie passed, it just wasn't the same for me. But also, watching them over the decades, they're not quite the same these days. They just don't. They talk a lot slower, and what they've said in the past. I've digested almost everything, so I don't get a lot new. The meeting for me is more about meeting people from around the world that I know and have got to know through the value investing community and conferences that I go to. That's why I went. So stepping down is not a big deal. The market may react badly. I don't know. But that doesn't bother me when they have $300 billion plus of cash. If the stock really sells off, they'll put that capital to work by buying back their stock. Is now a good time to buy the stock? We own it, and we've owned it for a long time. Right after I started the firm, actually, right before, the stock was trading just over book value, 1.02 times book value, which I knew was mispriced, so I bought it. Mm-hmm. Personally, I've just never sold it. I think at these levels, it's probably fairly valued, so I don't find it that attractive here. It's a wonderful company. It'll continue to compound probably at high single digits, but at these prices, I don't think you're getting a bargain.
It's interesting, and maybe part of it is succession, but everybody looks at that cash pile that you referenced and said, why aren't they buying? And as value investors, everybody just has to infer Are they not buying because they just don't see value out there with markets at all-time highs? Is it just to give a huge amount of dry powder to the next guy? What do you infer from that cash pile?
Well, so it's not to leave a cash pile for his successor. He actually commented on that in this meeting. He said, I wish I were that noble, but I'm not. If he found something to do today at the right price, Warren would pull the trigger. I have no doubt. And I think there was something in the Wall Street Journal this week that they've hired Goldman Sachs because one of the railroads might be in play.
Yes, BNSF.
Warren will put the money to work tomorrow if he finds the right opportunity. Berkshire has gotten so big that their opportunity set has really shrunk, and he's never relaxed his standards in terms of what he's prepared to pay. Also, his circle of competence, Apple was probably the first major technology acquisition or investment he's ever made. He doesn't know that space. Charlie didn't know that space. At GreensKeeper, I'm a generation younger. I grew up with technology. I'm not managing, $1 trillion company. I'm managing a fund of less than $200 million. I can invest in places that they can invest. So I just think it's harder for him. And I wouldn't read too much into the fact that he hasn't spent it other than the market is expensive.
It's funny you mentioned railways, because that's our next question on CN Rail. And you're right, there seems to be love is in the air when it comes to railway consolidation, and that maybe CN Rail is on the outside looking in. For a third year in a row, they have now cut their profit forecast, and the stock is languishing. And, I'll put my hand up. I was a sucker for CN, trading at a discounted valuation, good long-term business. They're not building new railways, holding for 20, 25 years, and it just keeps going down. What do you do with CN Rail?
Well, I don't own it. I don't love the rails personally, so I can't comment specifically on CN Rail. It's not my style of business, Amber. I'm not going to speak to the valuation because I'm not an expert on it. It's a capital intensive business. I like businesses that tend to be asset light and with a lot of free cash flow. You have to be a really good operator to operate a railroad, and so I don't know the answer, to be honest with you. And the thing, as a value investor, is I don't have to know every single stock. There are 3,000 stocks in North America. I tend to hunt in Western Europe, Australia, New Zealand, Canada, the US. I stick to the West, jurisdictions that respect the rule of law. But I don't need to know every sector. I just need to find 20 high quality businesses to build a portfolio. And I find it surprising sometimes turning on BNN or watching your podcast or some guests know so many stocks. I just don't know how deep they go. And some do, but I tend to hold companies for a long period of time, and we go really deep and we own them for years and years, and your knowledge improves over time. So my style is very different.
That's good perspective. So you're not making decisions in the portfolio, but you're actively working. I guess, what are you doing? Stress testing the thesis? Going to those Nike stores?
We read all day long. Like if you walk into our office, we're just thinking. We're reading. Today, 4 of our companies are reporting today. We're going to read the latest quarter. We're going to update our models. My analyst and I are going to talk about, has their competitive position changed? Is the moat or sustainable competitive advantage, is it shrinking, getting bigger? What's happening in the business? Is it getting worse? What's the valuation like? And we just do that over and over.
And to go back to the rail, so even though you're a value investor, it's just not a sector that you like because it doesn't meet your other criteria.
Correct. So I don't spend time on it.
So let's apply some of those questions that you asked to Lockheed Martin, which reported this week. And, considering everybody's high on defense spending and budgets are going in the right direction for defense spending, I'm looking at Lockheed Martin that's trading at the lowest level since 2023. Why is Lockheed Martin not rising with the defense tide?
So they released their quarter yesterday. They had a $1.6 billion write-down. Some of that was for the Canadian helicopters and Turkish helicopter program. The big portion of it was for a government aeronautics program that they can't talk about. It's a black box.
Classified.
It's classified. So some new system that they're working on, I don't know what it is, and management can't tell you what it is. Lockheed and General Dynamics, which reported today, I think the stock's up today, they're okay businesses, and they're 5% of our portfolio. We wanted exposure to defense. We bought these stocks years ago. Just the world's a dangerous place. We thought that they were attractive at that level. I think Lockheed's up 30% from where I bought it, and General Dynamics 136. So Lockheed has not been a great investment, but I wanted exposure. It's down because of what happened yesterday, but also the F-35 program. I know the Trump administration has suggested we're going to go to a next generation. But what people forget is the Turkeys of the world, the Canadas of the world are buying the F-35s. There are multi-year backlogs. So the company's going to be fine. It's not an amazing business, but I think that's the current sentiment, which is why Lockheed is trading much lower than where their competitors are.
So do you own it still?
I do.
It doesn't sound like it's your favorite child in the portfolio. Do you have a preferred way to play defense? Because you say it should be something you have.
Well, I wish I had done this a year ago, but the European defense contractors, which I did not know as well, have done amazing. And that's because NATO countries in Europe are now spending way more money. They're going to end up purchasing some North American or U.S. defense supplies, but they're starting to support their own industry. So that was actually the better place to be. I missed it. But, you
can't catch them all.
You can't. You try to in this business, but no, you can't.
Before we go to break, let's just squeeze in Google here. Alphabet, of course, the parent company of Google. This question coming from Arnie in Toronto. Okay. Is Google a buy because of Waymo? Do you think it's too behind on AI to compete against its tech peers? By the time this podcast comes out, Google's earnings will be out.
Yes.
And it's the cheapest, I believe, of all the Mag 7 stocks. So is that attractive to you?
It's the only one we own, and I think it's our second or third largest position. We like it here. Again, I have no insight into what the quarter will be tonight. It can be really volatile on the quarter. It's the only one of the Mag 7 that we find attractively priced. It's a very good business. I think they're well positioned in AI. They're not ChatGPT in terms of consumer awareness, but Gemini is pretty good. We use both at GreensKeeper. They have distribution through Chrome and Gmail and other products. Our view on these artificial intelligence or large language models in particular, we think they're going to become commoditized in time. They're all getting so much better so quickly. They're going to become more efficient at it. The only people that can really play in this space are people with capital. The Microsofts, the Google, ChatGPT seems to have an ability to raise capital. We think there's just going to be a few winners, and they're going to monetize it in time. We like Google here, and it's not because of Waymo. I just look at the free cash flow. Their ad business continues to grow well. The stock has also been weighed on by a few major litigation.
Regulatory.
Yeah, they were sued by the U.S., and they lost one saying that Google was a monopoly. Well, yeah, they have 90% market share. So I think what's going to happen, the remedies has yet to come out. That'll be later this year. I think the judge will likely say, they're not going to break up the company, in my opinion. It's possible, but I don't believe that. I think what will happen is they'll have to they will be precluded from paying Apple to be the exclusive search engine. There's going to be a choice screen for you and I and all users, and they won't have to pay Apple $20 billion a year for that privilege. So it's a modest negative, but I think they'll get through it, and I think they're fine on AI.
I've even spoken to people who say, yeah, if they break up the company, go ahead. Like there's tons of stuff in there that they're not getting credit for, and we can unlock value.
Yeah, I've seen that some of the parts argument with Waymo and YouTube is, I think, the most watched thing on TV now, more than cable and anything else, more than Netflix. So you could make that argument. There are benefits to having them together. It's really about the data. And they're an amazing data company. So sharing data amongst the different division has advantages. I hope that they don't get broken up. I don't believe that they will be. I don't know that it would be a disaster if they were.
I imagine you're a long-term holder of Google.
Yes.
It's not a new position, so you're probably up huge.
Yes.
And so, speaking to how you say, we're just thinking all day long. So the release of ChatGPT to now, you've just held on to Google.
We added.
Okay, you added on some of the weakness because there was weakness there. So just help me understand how you got comfortable around Google's position in AI, because for a long time it was looking very shaky, right? Google was really underperforming.
They were, and I remember the founders, Page and Brin, called it a red alarm moment. I think Google within their DeepMind segment, which is where they do their AI work, they were actually very early in the space. But they lost to GPT in terms of bringing it to market. And I think ChatGPT had a bit of an edge in terms of performance. If you actually look today, there's a website I go to that shows the different models and how they rank across different metrics.
Interesting.
Gemini's right there. So, given their balance sheet, their history, their talent, I don't think you should count them out. And I talked to a lot of people about it, and we came to the conclusion, as I said earlier, that I think these models are going to become commoditized over time. And so with that view, I could be wrong, but with that view, I think Google's going to be just fine. When you look at the numbers and their free cash flow, the core business today, I mean, AI is in the future. The core business today is generating tremendous free cash flow. It's still growing at high teens, double-digit growth rate. It's immensely profitable. They don't have any debt. They have tons of cash. Unless the business is broken, it shouldn't be trading here.
And all of this is publicly available. Like,
Correct.
It's not secret. So why does it hang out there trading at less than 20 times earnings, less than the overall S&P 500? It just do you ask yourself, like, what am I missing? You must be missing something, or we all must be missing something.
Yeah, I ask myself that all the time. There's a company we're going to talk about later where they reported today, and the market had a reaction that surprised me and my analysts because I have a different view, and I always try and understand, what am I missing? What's the bear case? It's important in this business to know that the market is not stupid. Mm-hmm. Often it's right, but not always. And so when a stock differs from that's what we do. We do our work. We come to a conclusion. Why was I able and Warren able to buy Apple at 10 times earnings net of cash 10 years ago or whenever it was? Because he had a different view. They had pricing power. The business wasn't broken. Amazing quality business. You can see it in the numbers. So if what has happened in the past is going to continue, it's mispriced, but the market gets really bearish sometimes. And if you get the business right, your investment's going to work out.
Yeah, that one seems like it's hanging out right in plain sight. We're going to take a quick break, and then we'll dip back into the mailbag. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. Okay, we're back. Let's talk about the stock exchanges, particularly Intercontinental Exchange, ICE. What do you think about exchanges in general, or ICE in particular? This one coming from Doris on X.
Okay, so Doris, I'd say, if you had the opportunity to buy a casino, as opposed to sitting at the blackjack table and playing against the house, that's how I view the exchanges, especially in this era where people are trading a lot of derivatives, a lot of options. We own both CBOE, the Chicago Board Options Exchange, and the Intercontinental Exchange. Intercontinental Exchange owns the New York Stock Exchange. The equity trading business is not as great. Today, there are more exchanges and the margins have come down. But the best part of ICE's business is the derivatives business, the clearing business, and the data in particular. In all of those segments, they have unique assets that they can increase price every year. I mean, we're a small firm and we pay an outrageous amount of data to all the exchanges because we need it to do our business. I can't imagine how many licenses a JP Morgan of the world needs. And so they just take price every single year. Intercontinental Exchange is a business with 50% margins, operating margins, not gross margins, operating margins. Tremendous free cash flow. I think the founder of the business, Jeffrey Sprecher, I might be pronouncing that wrong, he is the one that created this business. He's still in charge. He is an outsider, if you've ever read that book. He's a great capital allocator. He thinks differently. His next chapter is he started to buy some mortgage technology businesses, and he's trying to put that sector so that he's bringing technology to it, and we give him a lot of credit. We're not buyers of the stock here. We own it. We've owned it for a long time, and it's up significantly. That's
a good teachable moment, I feel, because you're a value investor. You can buy a value stock that is no longer a value stock as you hold it.
Yes.
Does that trigger any action on your part?
If it's a compounder, the answer is no, Amber, and that's our preference. A Visa, an Intercontinental Exchange, a Fiserv, these are businesses that grow double digits year after year after year. If you get the opportunity to buy it at a reasonable price, I think the answer is you probably almost never want to sell it.
I almost wonder, you didn't mention whether you own the TMX group or not.
We do not own the TMX group.
And I'm assuming, have you looked at it?
Yeah, I may have owned it.
The chief complaint often is that it's expensive.
Well, I haven't looked at it recently. I may have even owned it like a decade ago. I can't recall. I think they're more exposed to equity trading, which is the less attractive part of the business to me. The CBOE, when you have a contract that is exclusive to your exchange, liquidity begets liquidity, everyone's going to come to your exchange and you have pricing power. CBOE owns the VIX. There's only one VIX.
Yeah.
So I can create products off of that that are intellectual property, and I can price it expensively, and they have to come to me.
If we're talking value, we have to talk about the health insurers in the United States, because all of a sudden there's value there, a tremendous amount of value, but you have to ask yourself, is it a value trap? And so we've got a question about Elevance. Is it a good time to get into Elevance Health after its big drop? This one coming from Peter on X. And we've talked about this a lot on the show. Why are these insurers in so much trouble? And the simple explanation is they kind of just mispriced how much they were going to pay versus how much they're taking in. There's regulatory changes that make it a bit more complicated. And for United Health in particular, there is increased scrutiny on their practices. So there's a lot of hair on this sector, but things get cheap for a reason, and this is the reason.
Yeah, so you do your work on it, and we've looked at United and we looked at Elevance. We own Elevance and have owned it for a long time. The reason that we prefer Elevance is they have a big commercial business, selling to businesses as opposed to selling through the Obama exchanges or Medicaid or Medicare. When you're dealing with the government sector, they dictate pricing. Whereas when I'm dealing with a company, the market dictates pricing. So we preferred Elevance for that reason. They're also, they have good brands in the US. The Blue Health brand is their brand. Blue Shield, I'm sorry.
Blue Shield, yeah.
In many states. So they had a quarter this year. These are companies that don't make high margins, probably 4%. This is a scale business. And this year their medical costs relative to what they priced went up by 2%. So that's a big deal for an insurer. And you saw the same thing at United Health and some of their competitors. The pressure is not in the commercial business, it's in the government business. So they did misprice. It takes time to reprice it. But even with that mispricing, they're going to earn $30 a share this year. That's their new guidance. The stock's trading around $300. Again, this is a company that historically has compounded EPS at north of 10 to 12%. That's their long-term guide. So we think it's mispriced. It is not going to turn around tomorrow. This is a 2026, 2027 story, but we tend to view it as being underpriced at this level. Did
you buy more or you're just going to keep holding?
No, it was a big enough position for us. And there are issues. Like, again, with the Trump administration, you never know what they're going to do. If they woke up tomorrow and said, well, we're cutting Medicare rebates or what we're paying the insurers by 10%, it would kill that part of the business. So there is risk in that business. So we're not interested in adding to it. If we didn't own it, we would probably buy it here, yes.
I bought United Health, I have to confess. How's that going to go for me?
It's always been the best, and it's always traded a premium multiple. And I think they're really good operators. The two things that concern me, they fired their CEO, which is never good. They also had that horrible targeting in the U.S. Yeah. All of the insurers are not liked because their job is to control costs. And so sometimes they're going to deny. Sometimes the denials are legitimate. Sometimes they're not. And a lot of people try and game the system, and there's a lot of fraud, so they have to be vigilant. But United, what makes me nervous is some of it's reporting coming out of the Wall Street Journal suggesting that they were gaming the government by miscategorizing some of the claims.
Yeah,
I can't underrate that just because I don't know how big it is. But to me, that comes down to culture. I saw something, there's a tell in their last quarter that I read about. So the company met its numbers, I believe, but when the 10Q, the quarterly report actually came out, there was a gain on sale of a business that they sold to private equity. It was alleged that they were potentially going to buy it back in the future. I think they have an option to buy it back. So they were selling an asset to meet numbers was the implication of the article. And if that's true, and the analysts, when they poured over the quarterly statements, seemed to suggest it were true, to me, that's misleading because they didn't put it in their press release. They didn't talk about it on the call.
That's like financial engineering, a generous way of putting it.
Yeah. And so it's not illegal. It's not inappropriate. But
It's a red flag.
I don't trust management. They weren't honest with me about how they met that quarterly earnings. And so when you see that, when you see the suggestion that maybe they're playing games with Medicare, it's the cockroach theory. I don't know if there's a cultural issue there. And maybe there isn't. I might be totally wrong. But when I see that, I tend to stay away.
That's great perspective. I wish I had it before I bought the stock.
We don't get them all right, Amber. You're not alone.
Okay, let's talk about these credit card companies because you've mentioned them a few times.
Yeah.
American Express, which I believe you also own.
And Visa.
There's some wobbles. I feel like there's always wobbles. Everybody sees a new technology. Now it's stable coins. And everybody's like, this is it. They're going to get disrupted. And then they sell down. I think there's been a recovery from those fears because the stock, like Visa, is so well loved that the minute it gets cheap, people are like, oh, great, I can get back in. How do you think about this sector and why do you love it?
Yeah, I'm a payments nerd. We own a lot of stocks in this sector, and it's one of the sectors I know the best. I've owned Visa for a long, long time. Our cost base is probably $80. I hope I never sell the company. And I think about 5 years ago, I might get the timing wrong. There was a big fear at that point in time that India's new payment system or Brazil's new payment system or China's gone the WeChat QR code route. Technology, buy now, pay later is going to disrupt them. And so you got to think about, am I wrong? And we did a deep dive. For any other payment geeks, it's on our website. There's a Visa memo from 5 years ago that really went into it. Our conclusion was in any market where Visa, MasterCard, American Express were already entrenched with the consumer habit, that network effect had taken over, they've never been displaced. In a new market like China that doesn't have a credit card culture or didn't, and the government weighs on the scales and tries to favor certain technologies, that can happen. And India did the same thing. So our view was the business wasn't broken. Buy now, pay later, I think is going to be immaterial. I don't know that it's a great product. I don't know that it works even for the companies financially. So our view at that time when the stock was, I think it dipped down to $180, we thought the market was wrong. And we reloaded and we reloaded big time. And so...
Which is great, it's trading at above 350 now.
Yeah, and so you don't get those moments very often, and you can't just say, well, the market's wrong, it always goes up. You got to do your work. You got to make sure you're right about the business long term. But I'm paranoid about it because of all these technologies, stable coins. We think about it. Can it disrupt their business? And I always remember Charlie Munger 10 years ago saying, if you think you know what payments is going to look like in a decade, you're delusional. So maybe I'm delusional, but I made a bet, and so far it's proven to be right. And so that's what we try and do. We buy those great compounders when they're on sale.
I remember I listened to a talk 10 years ago. I think it was from a dragon, but I can't remember who it was. And he said, if Visa came after blockchain, you'd be like, wow, there's someone I can call. There's remediation. Someone's going to help me if I do a fraudulent transaction. Like, that's incredible. There's customer service. Which of course you don't get with blockchain. Have you done the work around stable coins? Those stable coins is basically, you're just cutting out the middleman and you're transacting with something that's not crypto. It is backed by the US dollar, but it uses the technology, I guess, the crypto technology.
Yeah, I've studied it.
So that I can transact, like if you're Amazon, I can just transact just with Amazon, no middleman.
So Visa, MasterCard, they're all acting as on-ramps to get into this technology to bring some of the consumer protections that you're talking about. I was less concerned about Bitcoin in particular because it's not great as a store of value. It fluctuates. A stable coin, there was a company called Tether, I believe. They always say we're backed by all these great assets, but their audits are a little
But thin. Now they will, but because of the changes in legislation, it's
real
to.
Now.
It's real.
Circle in particular, I think, is best of class. And there'll probably be more stable coins coming out. So how do I think about it? Why would I want to pay with a stable coin? Some people will. I mean, there's certainly a portion of the market will do it. I don't know how that's better than using my Visa card. If I'm a big spender on Visa, like effectively it's paid for by the merchants. I get why the merchants don't like credit cards because they're funding the ecosystem. But as a consumer, it's really easy. I trust Visa or MasterCard, or American Express, and they're kicking back a portion of my spend every year. I make a lot of money on my cards because I'm not a revolver. I pay my balance at the end of every month. So it works. Doesn't cost me anything.
You get points. People love
you
their
get a
points.
lot of points. And so I don't think it's broken. I just don't understand the utility of a stable coin for people that are credit worthy and have credit cards. I don't think it's any easier to transact at the till. In fact, it's probably a little more friction. I think where stable coins will probably make more sense are in remittances, where people are taking a huge spread today. Or if you're in a country like Argentina, or a country that dealing with hyperinflation like Turkey was a couple of years ago, I want to get my assets out of the currency I'm in and into US dollars. But in my country with currency controls, I have a hard time doing that. I think this may facilitate that. And from the US's perspective, it creates a demand for treasuries with the new regulation.
Let's end with luxury, because I wonder if luxury is cheap right now. One stock that we got a question about is about Richemont. What do you think about Richemont? It has also been under pressure. It's not as under pressure as like an LVMH, for example. So how do you think about, like, first of all, what's ailing luxury? And how do you think about whether there's value there?
What's ailing luxury, and we own Richemont, full disclosure, is primarily the Chinese consumer, which has become a big purchaser of luxury goods. I mean, these companies are still doing well in North America and Europe, but Asia and China in particular has become a big portion of their sales. And the Chinese consumer is hurting right now. You know, they're retrenching. First you have the real estate contraction. Now you have the trade war. So they're being very conservative. And so when you lose a big portion of your revenue, that's why the stocks are trading where they're trading.
Plus travel too, right? If there's not travel to these stores, often there's Asian demand showing up in the New York on Fifth Avenue.
In Japan, correct.
In Japan, yeah.
Yeah, so you get a little bit of that if the Chinese consumer is not traveling as much. Our thesis is, I think luxury is here to stay. There's a fundamental human need for wealthy people or aspirational people to signal their wealth. I think that's just innate in people. And so certain companies in luxury can be attractive. We like Richemont. The reason we prefer Richemont is they have a division called branded jewelry. They own the Cartier brand. Van Cleef & Arpels is another one. And those are iconic brands that were created a long, long time ago. Cartier in the 1800s, Van Cleef & Arpels, I think, in the 50s. You can't recreate those brands. And so as the biggest branded luxury jewelry luxury company in the world, that's a great segment. And that's most of their profitability. They also have a specialty watch sector. Mm-hmm. You know, the watches are okay. I don't view that as being as strong a business. And then they've got a few smaller businesses like Peter Millar, which is an okay business. So we really bought it for the jewelry segment.
Why Richemont over LVMH? Is it because of the jewelry segment?
Well, we own a tiny piece of LVMH, so it's primarily valuation. I think LVMH, again, is best of breed. They're bigger in leather goods, which has really good margins. And again, they have iconic brands, but it's never traded nearly as cheap as Richemont. Richemont has cash on the balance sheet, no debt, kind of a quirky founder, but I like him. Rupert is his name, Johann Rupert. And it kind of came down to us to valuation why we put our eggs behind Richemont, and it's worked out. And the stock has sold off recently. But again, Amber, I'm not predicting what it's going to be this quarter. And as the consumer has retrenched a little bit everywhere, and particularly in China, the branded jewelry sector has been one that historically has grown faster than luxury in general, and it's held up better. And so that's why they haven't sold off as much. We bought it a long time ago, and we've done quite well, but I don't think we're adding to it here. It's probably maybe a little bit undervalued here.
Okay, well, let's find out what you do like and what you are adding to. It's time for Pro Picks. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, your first pro pick, and kudos to you because you picked it before quarterly results came out. And you're still sticking with it.
Unfortunately, I owned it before quarterly results came out.
Yeah, and you're sticking with it because post-quarterly results, Fiserv is down 17% on my screen right now. You've had a few moments with the quarter. I know you haven't been able to go in depth. But basically the outlook, market didn't like the outlook that it provided. It's a fintech. So maybe let's start with the ABCs. Like, what does it do? Sure. What do you like? Well, then we'll talk about the myths, and then we'll talk about why you'd buy it.
So they've got a couple businesses. First, on the banking side, you go into your bank, you make a deposit, you write a check, you want to transfer money. The technology that banks use, their core banking technology, that's one of their divisions. Very sticky business. There's a handful of banks in Canada, but there are thousands in the US. They're a major player in that. And once you have a bank customer, you're not going to want to switch out your banking software very often. It doesn't grow very fast, but it's a good business. High margins, very sticky. Also, those banks issue credit cards. They handle the credit card issuing part of the business for them. The switching, connecting to the networks. The other side of the business is merchant acquiring. So if you go into a merchant and you go to Starbucks, you tap your card, that merchant has to connect to Visa. They have to get a bank to connect them to the system. That's called merchant acquiring. And that's the other part of their business. And so if you've ever seen some of the terminals, Clover terminals at restaurants, that's their product. Clover's been a very good growing sector for them. So the business generally does 30% operating margins, very good margins. They have delivered double-digit earnings growth for 40 years in a row. Based on their guide as of this morning's press release, this is going to be 41, I believe. They're guiding to, I think, about 15% revenue or earnings per share growth this year and 10% revenue growth. So I looked at the quarter this morning, and I've owned this stock for a long time. We bought it south of $100. It went to $220, $230, and now it's, I think, probably $130 today where it's trading. So, we've held it throughout that entire period of time. And at 220, the market probably got ahead of itself and it was in love with the stock. Now the market hates it. Mm-hmm. And so the bear case for the company is, well, Clover is slowing. Their transaction volumes, which used to grow double digit, are only growing 8%. But that division is still generating 30% revenue growth. They're selling hardware. They're selling value-added services. When I looked at the quarter this morning, my analyst and I talked about it. We thought it was fine. There were a few things in there, like the revenue growth definitely slowed a little bit. They gave away a little bit of margin.
Specifically in that merchant side of the business. Right.
And so management was asked about that. I think they're having to invest a little bit more in that. But going back 2-3 months, we compared their competitors to see, are they losing share? If they're losing share, I'm a little more concerned. But we saw a slowdown throughout the sector. So I think part of it is just the consumer slowing down their spending. And again, the number of transactions that are done will drive revenue in that sector.
And to your point about getting these banking customers and clients, they bought a part of TD's merchant processing unit, which I think is really just, it gives them, that's a new customer, right?
It's scale.
In TD, that's scale. And so is that material?
We don't think it's material. I glanced at it, Amber. It just came out this morning. I think it'll be less than 10% increase to that segment of their business. But again, it just shows that it's a tough business. You have to continually win business when a contract comes up. Competitors are in your face. It's a brutally competitive business. To win, you got to have scale. They're one of the biggest in the world.
It's also a good example of just because you own a value stock doesn't mean it can't drop 20% in a day.
It can drop 50%.
It can drop 50%.
So
it shouldn't happen as often.
But it does. So the efficient market hypothesis, the market doesn't always get it right. It often gets it right, but you don't get an opportunity to buy great businesses at a decent price. So we looked at the bear case, and again, I'm going to go back to the office and read the transcript. But I talked about it with my colleague for half an hour this morning, and we had a different view. It didn't surprise us that the stock was off. We thought maybe it'd be off a few percent, 20%, and where it's trading today. Again, high level, a business that has delivered double-digit earnings per share growth for 40 years. And even their guide this morning means it'll be 41. That business shouldn't trade at 12 or 13 times earnings. The company is buying back $2.5 billion worth of stock a quarter. Management is telling you what they think of the market price, and the market disagrees. So in time, someone will be proven right.
It's also a new CEO. Does that create anxieties?
I think it does. We talked about that this morning. I said that Frank Bisignan, I'm not going to get the name right. The prior CEO was invited to join the Trump administration, which he did. The new CEO has been in the chair less than a year. He is not going to get. He's not going to have the same benefit, get the same benefit of the doubt from the street, and so that could be part of it. And he has to prove himself to be credible and all that. But the business and their culture. I take a lot of comfort in that. And I don't think the business is unraveling. The market seems to be saying that the business is unraveling. And I disagree.
So you'd feel comfortable stepping in?
Oh, yeah.
All right. We love that. This is right up my alley. I love that stuff. Okay, let's talk about your second pick, which is Icon PLC. The ticker is ICLR, trades in the U.S. as well. It's, what is it, Global Pharmaceutical?
It's a contract resource organization, or CRO. They service the pharmaceutical industry.
Okay.
So when before a drug comes to market, if you're a Pfizer or you're a Merck, you have to go through clinical trials, both to assuage the regulators in Canada, the US, Europe, that your drug is safe, that it's effective, and that it's better than something that's on the market. So their job is to run clinical trials for companies. If you're a small biotech or a mid-sized company, maybe you haven't been through a clinical trial and you don't know the procedures, how to deal with the regulators, how to create your submission. You have no choice but to use one of these CROs. If you're a mid-sized company, maybe you do a little bit in-house, but you tend to outsource a lot of it. If you're a big pharma, you're going to do a lot of it in-house, but you're also going to outsource because these businesses, because they work for everybody in the industry, they have global scale. And so I can run a global trial at our facilities. In addition, they tend to have very deep expertise in certain segments, whether it's stem cells therapy. And so big companies like Pfizer or Merck will outsource a portion of their business to these companies. So you need to be big, and the industry has consolidated over time where there's three major players, IQVIA or IQVIA, MedPace, and the third one is Icon. Two of them reported yesterday. Icon reports after the close tonight. Before this airs, MedPace was up 50% yesterday. I think IQVIA was up in the teens, and ICLR, Icon was probably up 10%. It's trading on 12 times earnings. It's got a good track record.
Well, let's talk about why, when you get a big bounce like that, usually it's because the stock has been a dog.
Yes.
And so ICLR has been a dog. So that you explain why you like it. Why has it underperformed?
We bought it within the last 6 months. And
so
where the stock, well, we were following it. We liked the industry, and it finally got to a price where we thought it was attractive. We bought early. It's gone lower, and we're probably down, 10%, give or take. Why is it a dog? So the U.S. administration in particular, look, their Secretary of Health is a vaccine skeptic, Kennedy, right? He's hostile to traditional medicine. Our bet is this too shall pass. Science will win. You get measles outbreaks, people will realize, well, maybe we should vaccinate our kids. And every medicine has a side effect. So the skeptics will play up on that. Over time, research and development in pharmaceuticals has increased almost every single year over a long period of time. If that trend continues and the CROs continue to get their fair share of that spend, these businesses will continue to grow. And so when we looked at the space, we didn't care as much for MedPace. I think it's a good business, but they focus more on the really small micro-cap biotechs. And so that's a more volatile business because it's related to funding. IQVIA is best of breed, but the company is levered, which we didn't care much for, and it was on a relative basis, it was more expensive. We thought Icon, we really like their management team. They're cheap. They're good capital allocators. And I thought they had a really good business. They've got a good balance between contracts with large manufacturers, mid-cap, and small. So I think it'll be more stable going forward. And today I think it's around 12 times earnings. They earned $14 last year. This year, the consensus before the quarter was $13.20. A business of that quality, if the business isn't broken, shouldn't be trading there.
Well, that's interesting that this is an opportunity to take advantage of a nervousness in the market. Because if there's no vaccine, or if vaccine development slows or vaccine approval slows, then why do you need clinical trials? So then their business slows. Do you see their business slowing, or does it already price in the business slowing?
So the last quarter and their competitors cited an increasing number of delayed trials and canceled trials. And I think that was a direct impact from the Trump administration and the uncertainty. If I'm a drug company and I want to submit something to the Food and Drug Administration, if they're making major changes, I want to wait a few months to see how it's going to shake out before I commit capital, because drug trials are very expensive. So I don't know what's going to happen in the next month or two. Again, Amber, I'm making a long-term bet that I don't think new drugs are going to stop coming to market. I don't think drug research is going to decline over the long term. So markets get schizophrenic. They get really excited at times over things that don't make any sense, like Open Door trading where it is, because it's a meme stock. And then some businesses, the narrative just gets ugly. Now, fundamentally, and that's when they get cheap. Our job as value investors to determine, is it broken? Is it a value trap? If the business is broken, then it's a value trap. But if the historical trend is set to continue, then we have a different view of the market, and that's when you buy. I'm buying things when they're hated. And oftentimes the market is right. I look at a lot of stocks that sell, I love cliffs where the stock sells off 30, 40, 50%. I run towards it. Most of the time, I can't get there. I think the market is right. Something's happening in the business and it should be cheaper. It was either too expensive. The business has materially declined in terms of its future profitability. But once in a while, it's wrong. And that's when we make bets.
All right. Well, we found two of those potentially in Icon and Fiserv. Your third one, probably less of a household name, an Israeli-based company called Automated Bank Services. And honestly, the chart isn't as ugly as some of the other charts. But it's not like it's still down around 8% so far in 2025. What's the business? What do you like here?
Yeah, the business in the community is known as by its ticker SHVA, which is SHVA. That's what we call it.
Okay.
I'm a payments nerd, and I had never heard of this business. They are the Visa of Israel. They run the payment network for the entire country. I was in a conference in Switzerland. Somebody from Israel said, you should look at this business. And so I did. It's hard because it's a market cap. At the time we bought it, it was 150. Today it's about 300. It's a small market cap. If you know the history of Visa and MasterCard, they were originally started and then owned by a consortium of banks and then spun out. And now Visa and MasterCard have become better businesses than the banks they were spun out for. What's happening, I see the same roadmap in Israel. The government it was originally owned by the banks. The government wanted to create competition. So they said to the banks, you can no longer own more than 10% of the business. No person can own more than 10%. So the four banks did an IPO to sell their stake down to 40%. Visa and MasterCard was encouraged to come into the market and compete. And they said, no, thank you. The network is already established. So they each bought the maximum, 10% each. They're shareholders. They bought 10% each before the IPO from the banks that had to divest.
Yeah.
So you've got a company today with, I think, about a $300 million market cap, and 60% of the float is owned by 6 people. And so it's not a very well-known name. Again, I'm into payments and I had never heard of it. And their financial statements come out in Hebrew originally. The management has done a good job of getting them into English. It's a little bit delayed. So it's work to actually get to understand this business and the company. And you can be a small player like GreensKeeper, and I can play in these places. Buffett and a manager that's managing billions of dollars can't. And so when we looked at it, at the time we bought it, it was trading on 12 times earnings net of the cash. Again, incredible margins, high 30% operating margins. I think they got 150 million shekels on the balance sheet, no debt, just an amazing business. And they were going through this tough period where they were separating from a sister company. Again, the government's forcing them to do this. They're having to spend more money to build systems, to reinforce their infrastructure because of some of the cyber attacks they've received. So, you've seen margins come down a little bit. When we bought the business, at 12 times earnings, I think the stock was at 14 shekels. It went to almost 29. It's come back to 22. We think it's modestly undervalued today. I'm not pounding the table here. I think it's modestly undervalued. We're not adding to it, but if it goes, there's a price at which if it gets to it, we're going to reload.
When you've got 6 owners who own about 60% of the business, do you have to be worried about selling, like them just constantly selling, or you think they're strong hands? They'll keep a chunk of the business?
Well, I'll speak first to Visa and MasterCard. I mean, it's a rounding error, $10 million to these businesses. They're buying it for strategic reasons. They want to be tied to this business because internationally, SHVA just runs the network, the monopoly network in the country. As they go internationally, Visa wants them to use their network or MasterCard. The banks are the biggest customer of the business. They want to continue to have board seats, to have influence. The biggest lever the company has to improve the profitability is taking price. If you look at what they charge their customers relative to what Visa and MasterCard internationally does, it's like 4 to 6 times cheaper. So they've got a ton of pricing power. And our bet is over time, management is going to increase prices in that business. Again, this was like a government, quasi-government. It was owned by the banks, but they ran it like a utility. There's no market pressure to increase margins to make the business grow. Now that it's public, they took price 2 years ago for the first time in 10 years. They raised their prices. And again, they're still way off of where the market is. So our view is transaction volume in Israel will continue to grow. They also run the ATM network. They're a monopoly there. Peter Thiel once said that competition's for losers. Monopolies are great businesses because you've got pricing power. Now the regulator, you got to keep them happy. You got to keep your customers happy. But Visa and MasterCard have shown that over time, they can take price almost every year. And that makes for a great business. And you take price with a business today that's not operating on all cylinders, and it's still doing 30, 40% margins.
All right. I love this under the radar pick. Thank you so much, Michael McCloskey. I've learned a lot in this episode. Thanks for joining me.
Thank you for having me, Amber.
This is the ETF Minute on In the Money with Amber Kanwar. Today we're talking about the CI Canadian REIT ETF. The ticker is RIT. And to do that, we've got Lee Goldman with us. He is a Senior Vice President and Portfolio Manager at CI Global Asset Management. Lee, thanks so much for joining me.
Oh, thanks, Amber, for having me. I'm very excited to be here.
I think Canadians love REITs, they love dividends, but let's start with the ABCs and just talk about the role that REITs are supposed to play in your portfolio.
I think a lot of investors do look to REITs for income. So if you look at the subsectors of the Canadian market, the GIC sectors, the 13 of them, the REITs are actually about second in terms of highest dividend yield. So telcos would be number one, not quite as high as it used to be because of the BCE cut. But REITs at about a 5.5% yield are right there. So for investors looking for income and actually tax advantaged income, because REITs are awfully more tax efficient than certainly regular ordinary income or than interest income, the REITs are a great spot to look.
Let's talk about how they're trading right
Sure.
now, because we've had a number of guests who come on the show and say it's cheaper to actually buy real estate in the stock market than it were to be if you were doing, a real land transfer. And that's just because these REITs are not getting full credit for the net asset value in their stocks. Like, how unusual is that, or how exacerbated is that at this moment?
Right. So that is one of the key metrics that we look at. Where are REITs trading in relation to their underlying NAV, or put it another way, where are the stocks compared to the underlying value of the buildings themselves? And that changes from time to time. We've had periods where REITs have traded at significant premiums to NAV. Lately, it's been more significant discounts to NAV, and that's for one reason or another. It started out with interest rates hike in 2022, which caused the REIT sector to come down. More recently, tariff trouble and what the impact that could be on certain subsectors of the REITs have caused it to trade at a bit of a discount. And just, I'd say overall, some negativity from investors. REITs have underperformed the broader market for the last few years. So that has discouraged some investors.
Now, REITs have underperformed, but I believe this ETF that you actively manage has not underperformed. It's outperformed the index. Talk to me about your approach and what you do to get that outperformance.
Yeah, it's had a great long-term track record. So the ETF sort of in one form or another has been around since 2004 and trading as an ETF since 2015 when it was converted from a closed-end fund. And since that time, we've actually managed to outperform the S&P Cap REIT Index across every time frame, basically from year to date to 5-year, 10-year since inception. So it's been a great long-term track record. I think part of that is, our active management approach. It's not just a passive ETF. We have a team of 3 very highly qualified investment professionals with tons of expertise in the REIT space that are managing the fund. We can get involved in non-index names, which definitely helps, and some of those are often the subject of takeovers. And also we can obviously change the weights around. So we're not just sort of hugging an index by any means. So I think that has helped out a lot. We're lucky at CGAM to have a broad team that covers things, everything from the macro level to interest rates to obviously very fundamental in-depth analysis. So I think we combine all of that into a track record that has proven to outperform.
There's a lot of exciting stuff happening right now. There's a lot of M&A, people looking to take advantage of these low valuations. What does that tell you?
Well, it tells us that REITs are trading cheaply compared to the private market. So just recently in the last sort of 2 months, we've had one M&A deal announced, which was InterRent REIT, getting taken out at a decent premium to where it was trading, a little bit of a discount to where our consensus NAV is. So we think the deal will get done. Whether they sweeten the deal a little bit is still yet to be seen, but still not bad for overall REIT valuations, and it kind of propped up the whole space. And then just about a week ago, H&R REIT, which is a company that announced a strategic review sort of 5 years ago and have been trying to reposition their portfolio. They announced, I guess, a week ago Friday, they've actually been approached by a couple of counterparties about a deal, which in a way surprised us because it's a diversified REIT. They have assets across various different subsectors of the market, from office to retail to industrial to apartments. So to us, it wasn't clear that there's one logical buyer, but it sounds like there's a pretty decent chance. So that got that stock moving in the rest of the REIT space as well.
M&A is one thing. Then there's also interest rates, right? If interest rates are directionally moving lower, is that a tailwind?
Generally, there's certainly not a one-to-one relationship between interest rates and REIT movements. But the volatility, certainly in the last couple of years where rates were generally going up, that didn't help valuations. So we think anything sort of positive on the way down will help. What we need more, truthfully, is just some stability and both in interest rates and just some confidence in the overall economy. And that will get further transactions going. That will give further clarity on pricing. So we think even rates don't have to go down much further, but they just have to kind of stabilize for the REIT space actually to work from here.
Lee, thank you so much for joining us.
My pleasure.
This is Lee Goldman joining us from CI Global Asset Management. Make sure you tune in to our next episode. We've got Seth Allen on the show. He's of the Cadence Financial Group, part of Raymond James, and he's going to be taking your questions on Canadian and U.S. equities. You know what to do. You can send us a question, questions@inthemoneypod.com, or you can find us anywhere on social media @inthemoneypod, and we'll see you on the next episode.